In today's lesson, we are going to be introducing a new topic, ratio analysis. When you started accounting, what was the main purpose of accounting? It was to provide financial information so that the users of the accounts, both the internal users and the external users, can make informed decisions. So in this topic, after we have prepared all our journals, ledgers, trial balance, and finally our income statement and our balance sheet, and we know how much profits we have made, we can still analyze the information and provide information that will be even more useful to the users. So comparisons have to be made over time and with other businesses to be able to see fully if that business is profitable or not. The best way though to make these comparisons would be to use ratios instead of just absolute amounts. So that is what this lesson is going to be about. How can we use ratios? What are ratios? And how they can be calculated to better give information. Our lesson, ratio analysis, it's an introduction. And this presentation is actually based off of our PowerPoint lesson by our HOD, Mrs. Nicole Gomes. Before we can start the lesson in terms of ratio analysis, we're just going to give an insight what exactly is a ratio. A ratio is a relationship between two things when it is expressed in numbers or amounts. So the emphasis is that a ratio or ratios are relationships. So for ratio analysis, the ratio analysis is the interpretation of the information found in our final accounts, which would be the income statement and the balance sheet, so that better business decisions can be made by the users of the accounts. Ratio analysis compares information in the income statement to understand how much profit is made from sales dollars after taking away all of the cost. These ratios are called our profitability ratios. In the balance sheet, relationships between current assets and current liabilities are used to determine the ability of a business to pay its short-term debts within a year. These ratios are called liquidity ratios. How efficient a business is can also be determined by ratios called turnover ratios. These ratios identify how often in days an activity takes place. So in summary, a ratio expresses the relationship between one accounting result and another, and it is intended to provide useful comparisons. So the best way that we can get information is to make comparisons over time with other businesses within the same industry to say that the business is operating profitably. So today's lesson, we are going to start with one of the three ratios. We stated that there are profitability ratios, liquidity ratios, and other ratios which express or analyze the activity of the business. So those are activity ratios. But we are going to start with the profitability ratios. And we will start with a definition. What is profitability? It is the ability of a company to use its resources to generate revenues in excess of its expenses. So in operating a business, the main objective of a business is to generate revenue. In order to generate revenue, we do need to incur expenses. So you need to spend money in order to earn money. So it is the degree to which the business yields profit. So notice the emphasis is on that ratios are relationships. And since we are starting with the profitability ratios, these ratios use relationships mainly in the income statement, which is used to calculate your gross profit and your net profit. So it is easier for someone to interpret information in relative terms as percentages rather than in absolute dollar amounts. So for example, the main user of accounting information would be the owner of the business, and things that the owner may want to know: how much of my sales is profit? Is it 10%, 25%, 40%? How much of my sales is the cost of my inventory? And lastly, what percentage of my sales are my expenses? So once again, profitability ratios use relationships in the income statement. If you remember your income statement, the information in your income statement would be starting with your sales revenue. And then after you have subtracted all expenditure, all cost, for example, your cost of sales and your expenses, you will arrive at your net income figure. So the absolute amounts would be your sales generated and your net income. So we would see in our example, we have business A and business B. So we have two businesses, and both businesses made a net income or a net profit of $15,000. So in absolute amounts, if you just look at the $15,000 net profit, you would say that both businesses were equally profitable in terms of the amount of net income they made. But then when you look at their sales figures, you would see that business A made $60,000 in terms of sales revenue, whilst business B made a greater amount in terms of sales revenue, $100,000. Which business would you say is more profitable looking at the figures? You may be tempted to say that because business B would have generated more sales revenue, $40,000 more than business A, that maybe business B is the more profitable. But then you look at it and you see that their net income was the same. So then you may be tempted to say that they were equally profitable. What we are saying is that to realize or to know whether or not business A or B was more profitable, you would need to look at the relationship between the net income and the sales to better get an idea in terms of the profitability. So we are going to look at each business in terms of their net income and their net sales, and we are going to use a ratio, which is your net income as a percentage of sales. And the formula for that would be net income over sales multiplied by 100. So we are going to calculate the net income as a percentage of sales, and you would see that when we calculated for business A 15,000 over 60,000 by 100 gave you 25%, and business B, when you had 15,000 over 100,000, that had 15%. So business A, 25% of sales was their income, whereas business B, net income was 15% of sales, which is less than business A. Business A yielded a greater percentage from its sales in terms of profit. So the information that is provided with these ratios is that business A earned 25 cents for every dollar of sales, meaning that they earned 25% in terms of profits from their revenue, whereas business B earned less in terms of their profit, only 15 cents for every dollar of sales. So business A is more profitable. Ratios are therefore used to make comparisons. We were able to now compare business A and business B, not just in terms of the absolute amounts, but because we did the ratios, we were able to compare in terms of the percentage of sales And that gave us more information to determine that business A was in fact more profitable than business B because they generated or they earned more income or more profit from their sales revenue. So the information we have there in dollar amounts and we have our ratios. We are now going to do it in a diagram form to give a better idea. We are going to use a pie chart, and the pie chart, sales revenue would represent your 100%. You start off with your sales revenue. Sales at 100% minus the 25% will give you your cost and expenses as 75%. So your sales revenue is 100%. Your cost and expenses would have been 75%, which left you with 25% as your net income. And you would see there that in blue, 75% represents your cost and your net income is the green area, 25%. This is for company A in terms of net income and sales. For company B, with the entire pie chart representing sales revenue, you would see that of that sales revenue, 15% remained as net income and 85% would have been the cost and expenses, the expenditure for company B. So looking at them side by side, you can see very, very clearly the green area for company A is greater than the green area for company B. Company A, the sales revenue was less than company B. In terms of company A was $60,000 and company B was $100,000. However, when you look at the pie chart, you would see that a greater percentage of company A's sales was net income, showing how profitable it was compared to company B. Their income is the same. However, you also see that your cost and expenses is greater for company B. Once again, showing that company A, even if you look at it, that company B made more revenue. However, you also see that your cost and expenses is greater for company B. You would see based on the percentages that company A was the more profitable one, even though they had equal amount of income. So we just did one of the ratios that used the relationship in the income statement as a percentage of net sales. The ratio that we used the net profit as a percentage of net sales. That is called your net income margin. There are two other ratios that you can use. That is your gross profit margin and your expense margin. These are two other ratios that use a percentage of your sales. So your gross profit margin uses gross profit as a percentage of net sales, whereas your expenses margin ratio uses expenses as a percentage of your net sales. You will see a similarity in all of the formulas. It is whatever the name of the ratio is over net sales multiplied by 100, and the answer is expressed as a percentage. So we are going to further emphasize the use of these ratios by an example. We have an income statement for the year ending December 31st, 2020. The man in green is our owner. And you would see that this business has a net sales of $800,000, less a cost of sales of $480,000. Gross profit would be $320,000. There was no other income received. There were expenses, however, of $120,000, which when deducted from your gross profit gives you a net income of $200,000. So these are the absolute amounts. Net sales $800,000, net income at the end after you have deducted all of your costs and expenses, $200,000. Absolute amount, but to get a clearer idea of the profitability of the business, We are going to do 3 of the ratios, the profitability ratios, the margin ratios, to get a better idea. And we will see there that having calculated in terms of our ratios, your gross profit ratio, 40%, your expenses ratio would be 15%, and your net income ratio, 25%. So do you notice how the gross profit margin, net income margin, and the expense margin uses the figures in the income statement above? Do you know how we got those figures? How did we get gross profit margin as 40%? How did we calculate expenses as 15%? And most importantly, how did we get net income margin as 25%? So your gross profit margin, what is the formula? Gross profit over net sales multiplied by 100. So you have the figures there. Your net sales, 800,000. Your gross profit, 320,000. So you plug it into your formula, 320 over 800 by 100, and that gives you 40%. And that is how we got our answer of 40% by using the formula. After we have gotten our gross profit margin, can we then find out how much percentage is the cost of sales? If sales is 100% and sales less cost of sales is gross profit, that means that your cost of sales would be the 100% minus your 40%. So this is how we get our cost of sales as 60%. Now to calculate your net income margin, you would use the formula, which is net income over net sales by 100. You will have your figures there. Net sales is 800,000. Net income is 200,000. So when you plug it into your formula, you will get your answer as 25%. Now we are going to calculate our expense margin. Same, we are going to use the formula, expense over net sales by 100. You have your figures there, 800,000 for your net sales, expenses 120,000. So you plug it into the formula and you will get your answer of 15%. So there was our working, all summarized. Gross profit margin gave you 40%, net income margin gave you 25%, and expense margin got 15%. So we are going to look at some relationships in the income statement where sales is equal to cost of sales and gross profit. So as we saw before with our income statement, the first part of our income statement, net sales, 800,000 less cost of sales, 480, gross profit, 320,000. So when we had worked out our gross profit of 40%, that meant that if gross profit is 40% of sales, then cost of sales would be 60%. Which is the 100% minus the 40%. Once again, we can see it very clearly in a diagram. Your sales is the full circle, which is the 100%, and you would see that your sales is now broken down into your cost of sales and your gross profit. Whereas your cost of sales was 60% of your net sales, and your gross profit that remained after you deducted that cost is 40%. Now what we are going to look at is another relationship. Gross profit is equal to expenses and net profit. So looking at the diagram again, you would see in the yellow area is your gross profit. Absolute amount, you have 320,000. In terms of percentage, it's 40%. But gross profit, 40% of sales. Gross profit is further broken down into expenses and net profit. How, after you have deducted your cost of sales from your net sales, you have your gross profit of 320,000. but there is some more expenditure that takes place. Expenses. Any expenses of the business must now be deducted from your gross profit. After you deduct your expenses from your gross profit, what remains at the end would be your net income. Hence, your gross profit is made up of expenses and the remainder, which would be your net profit. So in this case, we saw that our expenses was 120,000, which ended up as 15%, and your net income, which remained 200,000, was 25% of your net sales. You would notice that 15% plus the 25% is equal to your 40%, which is your gross profit. So looking at your diagram, you would see that your gross profit, that was yellow, you deducted 15% in orange of your expenses, and you remained with a net income of 25%. So the diagram shows you the three components of your net sales, which would be, you have your net sales, which is 100%, which is the full circle. Then you would deduct your cost of sales, which in this example is 60%, which would have left you with 40% gross profit. And then you would have spent expenses 15%, which would leave you with a remainder of 25% net income as a percentage of your sales. From your sales revenue, you would see that a great amount of the cost was in your cost of sales. So if you have to make a decision where you have to reduce any costs, you may have to look at how you can reduce your cost of sales. You may have to look at another supplier in terms of your purchases. But this would show users of the accounts exactly what the situation is in terms of the business and where you have to actually focus your attention to increase your profitability. And in this example, it is very clear to see that the cost that makes up the bulk of the cost that takes away from your profit would be your cost of sales rather than your expenses. So these are your three formulas for your percentage of net income: gross profit margin, net income margin, expense margin. Very easy formulas. They are whatever the ratio is over net sales multiplied by 100, and the answer is expressed as a percentage. So after all of that, you can just take a little break and then you will come back. Okay, so we're back. There is one other profitability ratio that owners are interested in but requires balance sheet information as well. So all the time we were looking at the income statement for the information that we were using in our ratios, the three ratios, the three margin ratios. But there is another one, and we have to go into the balance sheet in order to get information to do this ratio. And that is called your return on capital employed. How much profit am I making on the money I have invested in the business as capital? So what are your returns for using the capital that you have invested? Return on capital employed, ROCE. And the formula for that would be net income, which you get from your income statement, over capital employed multiplied by 100. And this ratio is once again expressed as a percentage. So your return on capital employed, also known as return on investment, net profit over capital employed by 100, expressed as a percentage. Capital employed for a sole trader is usually average capital. So we use average capital as our capital employed. If you do not have more than one capital figure, you may use whatever figure they give you in your balance sheet. So if you have opening capital or you have closing capital only, you may use that as your capital employed for your sole trader. Once you have both figures, your opening capital and your closing capital figure, you will find the average capital, which is simply opening capital plus closing capital divided by 2. So once again, your average capital figure, which we are using as our capital employed, will just be your opening capital figure plus your closing capital figure, which you would get in your balance sheet, divided by 2. And once you get that figure, you will just plug it into your formula. So your net profit from your income statement over your capital employed, which would be your average capital, multiply by 100. And in our example, our net profit is 7,200. We had worked our average capital or capital employed as 21,600 multiplied by 100, and that gave us a ROCE of 33.3%. That means that the business earned 33 cents for every dollar of capital employed, or their returns was 33.3%. They yielded 33% of capital employed in the form of profit. So the best way to reinforce would be, of course, to do an example. And you would see that we have a balance sheet extract where we have opening capital. We also have a net income, which we would have transferred from our income statement. And then we have our closing capital figure. So the formula would be net income over capital employed by 100. Because we are using average capital as our capital employed, that means our ratio or our formula will be net income over average capital by 100. And the average capital, opening capital plus closing capital divided by 2, which means it would be 150,000 plus 320,000 divided by 2, which gives us an average capital of $235,000. And when you plug that into your formula, you will get 200,000 over 235,000 multiplied by 100, which gives you a ROCE or return on capital employed of 85.11% or 85.11%. So that would be your ROCE, which means that you earn 85 cents for every dollar of capital employed. We have another ratio to add to those 4 ratios. Can you remember what the 4 ratios are? Gross profit margin, net profit margin, expense margin, and return on capital employed. So we are just going to add a gross profit markup. Notice the difference. Instead of gross profit margin, this one is a ratio called gross profit markup. This is calculated using gross profit over cost of sales multiplied by 100. And it is also expressed as a percentage. So if you remember the gross profit margin, the denominator was your net sales. For a markup, you just change the denominator from net sales into cost of sales. So we use cost of sales figure instead of net sales. So let us calculate the gross profit markup, and we are going to use the example from before that we had used to calculate the others. And we're using our new formula, gross profit over cost of sales multiplied by 100. Okay, so we have our information from our previous example where we have our net sales 800,000, cost of sales 480, and your gross profit 320,000. So we are going to calculate our gross profit markup. And the formula, once again, gross profit over cost of sales multiplied by 100, expressed as a percentage. So you see your information there in red, your cost of sales $480,000, your gross profit $320,000. When you put it into your formula, so your markup figure is 66.7%. So just to reinforce, we're going to do another example. Using the information above, calculate sales using your gross profit markup. So you would see there that we do not have a sales figure. We have a cost of sales figure, and we have that the business marks up its cost at 50%. So using the two figures that we have there, which is your cost of sales as $900,000 and the markup, the gross profit markup as 50%, we are challenging you to find your sales figure using the gross profit markup. So unlike previously where your net sales figure was actually your total figure or your 100%, whenever you are working out for a markup, your cost of sales is actually 100%. So your 100% cost of sales, your gross profit is 50%. So if sales is actually equal to your cost of sales plus your gross profit, that means that if you have those two percentages there as your cost of sales is 100%, your gross profit is 50%, therefore that means that your sales expressed as a percentage would actually be 150%. Knowing that, that means we can now work out what our sales figure in dollar amounts. By basically using the formula, it is 150% by 900,000, which would give you $1,350,000. So because we have our figures, we can now calculate our gross profit dollar amount or monetary amount using the figures above. Very simply, it's doing an income statement. You have your net sales figure, which is $1,350,000 less your $900,000, and that will give you your gross profit of $450,000. That is your figure for your monetary figure. What if we had not calculated our sales figure? You would just use your formula in this case. So your formula for gross profit markup is gross profit over cost of sales by 100%. So if your gross profit markup is 50% and your cost of sales is 100%, to find your gross profit markup using the percentages, it will just be 50 over 100 multiplied by 900,000. And that will give you your figure of 450,000. So we're going to send you with a wonderful little assignment to do. You have the information there from the income statement, and you have opening capital and closing capital figures. And you are going to go and calculate 5 ratios that we learned today, which would be your gross profit margin, expense margin, net income margin, return on capital employed, and your gross profit markup. You can use the formulas, so you can put it out like this, where you have your ratios, you have your formulas, and then you would have your calculations and you will get your answers. A worksheet will be sent to you, and then you can also present your answers in this format where you do your income statement and you put your figures next to the absolute amounts so that you can actually see the monetary amounts as compared with your margin figures. And you will also have to work out your ROCE separately and your gross profit markup using the formulas. In addition to doing the assignment and the calculations, have a little project for you where you can now go and you can do a diagram that would represent the profitability using 3 of the components. So the 3 components of the sales would be your cost of sales, expenses, and your net income. So just like we did in previous examples, you can do a diagram like this where you see the sales, which is the full circle, broken up into these 3 components. In terms of the percentages, the percentage would be your expense margin, your net income margin, and then your cost of sales percentage, which would be your 100% minus your gross profit margin. You can do this diagram in Excel or Word or PowerPoint, but it's a nice little project to see if you can do the diagram. And then we will have an additional challenge assignment, which would be to prepare the income statement using the following information and ratios, filling in the missing amounts and the percentage amounts. So this is an additional assignment. After you've done the other one, you can do this as extra practice for you, and we will correct it in another video. You would see if you understand fully. But it's basically memorize your ratios, the formulas for your ratios. Make sure always express it as a percentage, because all the ratios we learned today is expressed as percentages. Make sure and put percentage if you want to be totally correct, and to get the full marks you must put the percentage, otherwise it could be anything. So you can go away, do these assignments, we would correct it, and have some fun.